Welcome to another edition of Danny Brown Talks Phoenix. I am your host, Danny Brown, and this is our October monthly market update. And today I am joined, as usual, by Garrett Sergvenik. Last month, Garrett was on his honeymoon, so I flew solo, but now he's back. So Garrett, why don't you give us a quick little update on what's happening in the mortgage world?
Okay. Rates, as a lot of people are probably seeing in the media, rates are climbing. We're at a 7-year high right now. We haven't seen rates as high since 2011. And we are not far off from where they were, back before the recession. I think a lot of clients that I'm talking to are really surprised when I tell them what rate they're going to get. You have folks, for instance, I have a client in process right now purchasing a home, and he's got an 800 credit score. He's putting 20% down, and he's got a rate in the fives, and he can still get something in the fours, but he has to pay extra for it. So, that's a bit of a surprise to your higher, your well-qualified clients that, are used to seeing that and are expecting, a rate still down at the bottom when it just, they're out there, but they're expensive.
Right.
So that's impacting, what people can, how much they can buy, and really have an impact on their payment. If a 0.5%, impacts, whether or not you could afford another $20,000 to $30,000, when purchasing a home. So, I think, as I always say, if you're looking to do something, now is the time to do it. The longer you wait, rates are just going to continue to climb. The Fed is actually meeting next week to, talk about raising rates again. And it's almost a guarantee at this point that they are going to bump them up another 0.25%.
In December, right?
In December,
Yeah.
exactly. So it takes effect in December. Now, we've already known that that's probably going to happen. I think I touched on it last month or 2 months ago as well. So that's really already priced into where the market is right now. We're not expecting, after their meeting, no matter which way it goes, for rates to shoot up anymore. They've kind of leveled off. But you're starting to see a lot of lenders with a 6% rate on their rate sheet. And
I just closed somebody who paid 5.75.
Yeah. So I mean,
I have not seen that interest rate while I've been in real estate. I had that interest rate on my mortgage.
Yeah.
I was in the sixes,
Yeah.
but I haven't seen it in real estate in 11 years.
A lot of people haven't, and you have, so many first-time home buyers now that maybe, they just don't know where rates are at, and they're fine with it because they just don't know. But, folks that are, selling a house where they're at a 3.5% on their interest rate currently and trying to buy something else and going up 2 percentage points, it's really having an impact on their payment. So, there's also a few changes in, underwriting systems. Fannie Mae and Freddie Mac back conventional loans. So they set the guidelines and things like that. And they kind of are doing an overhaul right now in some of their systems. Fannie Mae's underwriting system is changing as of next month. And they're tightening up debt-to-income ratios and credit requirements. So not only are you going to pay more for your mortgage, but you may not be able to afford as much based on your qualifications. So, again, now's the time to do it. If you're on the fence, if you are looking, if you're saying, well, I don't know what I can qualify for, give us a call. Let's talk about it. And we can tell you what options are out there and, what's available in the market and, hopefully find something while something is still around for you.
Right. Well, thank you for that update on the mortgage world. In terms of what's happening in the real estate market, on a national level, so some of the good news that's coming out is that consumer spending is up for the 7th straight month in a row. So what that means is that consumers are buying stuff. So they're confident that they're going to remain employed. Unemployment is super, super low, and they're confident that their income is going to at least stay where it's at. So when people are buying stuff, that means the economy is doing well. The increase in mortgage rates that you just talked about, coupled with the increase in home values, has greatly impacted housing affordability. When you see those interest rates go up, like you touched on, by just a little bit, when you see those interest rates go up by just a little bit, it can really affect your affordabilities. But with that being said, despite the low inventory, we have seen a increase in total sales year over year. So this time last year, sales are up. So we've got that decreased inventory on a national level, but people are still out there buying homes, and they're buying them at a higher rate than they were last year.
Do they expect that to continue into next year, or is there any end in sight with this continued increase in
inventory?
Inventory, yes.
Yeah. So the increase in inventory is also happening in Phoenix, and it's really healthy for the real estate market on a national and on a Phoenix level. We've had just this low inventory for a really long time. The market has been a seller's market for a really long time. Sellers have held all the power. And so they're predicting that as affordability gets challenged and as interest rates go up, that more listings are going to sit on the market for a little bit longer. The list prices are actually starting to come down. We're seeing this in Phoenix. We're seeing this on a national level, but that's not affecting sales prices, which is really important to differentiate between the two.
Okay.
So we're coming out of an environment where sellers had all the power. They were super optimistic because they're hearing all these stories like, my neighbor listed and they listed at this price and they got 7 offers in the first weekend, and it sold for higher than they were listed at. And we saw that in Phoenix too, and that's changing. So in the last month, we've seen more price drops than we've seen in years. So price drops are up 27%.
Wow.
And we're also seeing a drastic spike in seller concessions. So sellers are giving buyers some funds to help with their closing costs, purchasing home warranties, those types of things to try and get their home sold to compete with their neighbors. So again, all of these things do not indicate that the market is taking a dip. It's just affecting list prices and not the sales prices. So it's so important to differentiate that. And they don't think that sales prices are going to be affected, that sales prices are not going to be in the 6 to 10% that we've been seeing. That's just not sustainable.
Gotcha.
So what we're going to see, and we are seeing, are sales prices are going to be right in line with where inflation is.
Okay, 2 to 3 to 4%, somewhere in there.
Yeah. So they're projecting that we are going towards a very balanced market.
Okay.
And you can see this if we have graphs, and we can send them out to you if you want to see it. But if you look at a graph from the year 2000 to today, you can see the spike in home values that happened during the housing boom from like 04 to 07. And then you can definitely see the crash that happened in 2008. And then you can see the market kind of recovering. And if you match that up with a line of where inflation has been, so the value of the dollar, our property values and inflation are intersecting right now. So in terms of where property values should be, they're exactly where they should be.
Wow. Okay.
So the home price, we're not overvalued. We're not headed towards any sort of housing bubble. None of that is in sight. Now, of course, I can't predict the future. So if there's some sort of economic disaster on the horizon, that of course could change things. But where we sit today, there is no indications whatsoever that we're headed towards a housing market collapse. There's no bubble. Sales prices are not going down. They're just right where they should be. And sellers just shouldn't be as optimistic as they once were.
Got it.
I think that we're going to get back into a market where sellers should expect 30, 60, 90 days or longer to sell their home. They're going to have, again, more price drops depending on where they price their home, and they can expect more seller concessions potentially as well. This trend is not affecting buyers in the sub 200,000 market, though. That is a very different market here in Phoenix. That is still, there's no inventory really available in that price range. Of course, the further out from the center of Phoenix you go, the cheaper the price. So we recently, just a couple months ago, closed 2 clients who purchased brand new houses, 1,700 square feet, Santan Valley, $200,000. So it can be done. You just might have to be a little bit further out if that's something that you're working towards, or if that's what your affordability is.
Got it.
So Again, I want to reiterate that price reductions do not necessarily result in a decline in sales price. It's only a decline in sellers' expectations for appreciation. So I think that should just really sink in for people. Again, sales prices are not going down. Let's see. I think that just about covers it. The last kind of thing that I wanted to talk about was the affordability in Phoenix. Right now, the rent for a single family home, about 1,800 square feet, 3-bedroom, 2-bathroom, which is kind of the average house. Yeah. The rent for that right now is about $1,400 a month.
Oh, wow.
Yeah. If you were to buy that same exact home, your mortgage is probably going to be around $1,700 a month. So, simple math, that's a $300 difference.
Yeah.
And what I would challenge people is not to say, well, it's going to be cheaper for me to rent than it is to buy on a monthly basis. It's what do you do with that $300 difference? Do you take that $300 difference and invest it? If so, then maybe renting is the smart move and you're investing that $300 elsewhere. If you're like a majority of Americans and you're taking that $300 and you're buying clothes, going to dinners, partying,
Starbucks every day,
buying stuff you really don't need, I would look at what you're spending on a mortgage on a monthly basis as not as an expense, but more of a forced savings account. So you're taking that $1,700 a month and you're investing it in an asset versus $1,400 a month you're investing in someone else's asset. Yes. And you're never going to get that back. So statistically, people who own homes and invest in real estate are statistically wealthier than those who rent. And it's because of that forced savings account, if you will. Because if your money, even if property values only increase with inflation, the value of the money returned to you, you're still getting all that money back.
Yeah.
Whereas if you're renting, you're not getting anything back.
And remember, it's twofold because you've got your home appreciating in value, so you're building equity there into your savings account, but you're also paying down the principal balance.
Yeah.
So on a $1,700 payment, you'll have $300 a month going towards principal, and that's just putting into a savings account, and then on top of that, remember the tax benefits.
Absolutely.
You can write off all of your mortgage interest, so it's even more money in your pocket. So in reality, if you're saving that money, it makes more sense. You're actually, paying less on a monthly basis to expenses that don't go to you than you would be if you were renting.
Yep, absolutely. And I think that's, again, goes to the reason why people who own homes are statistically wealthier than people who don't. You're just constantly leveraging that. And people who retire, usually their savings is tied up in their home. Yes. Because Americans are really poor savers.
Yeah.
We just are. We're all about living in the moment. And if you're paying that mortgage month after month, it's a forced savings account. So just wanted to touch on that. So just to reiterate, there is no bubble. The market is not, whatever clickbait you see out there, whatever headlines you're seeing on advertisements or news articles, there is a market shift, but it's very slow. It's very controlled. And all we're seeing is list prices go down. Okay. Nothing to do with sales prices. So if you're a buyer out there and you're saying, "Oh, I'm going to wait for the market to drop," that could be forever. Like, we don't know. We've had this will be our third transition from the recession, going from a seller's market to a balanced market. So we had one when the tax credit was issued.
Okay.
So that was kind of a false bump in the market when the government was giving first-time home buyers like a $7,000 tax credit. Then we had another one, and that's where a lot of Canadian investors were buying homes, especially in Phoenix, because the Canadian dollar was worth more than the American dollar.
Okay.
So they were investing heavily into specifically Arizona real estate. So that got us to a balanced market, and now we're seeing this one. But each of those instances, we didn't transition from a balanced market to a buyer's market. We transitioned from a balanced market back into a seller's market.
Wow.
On each of those instances. So we have no idea what's going to happen at the end of this balanced market that we're slowly headed towards. So if you wait to purchase because you think the market's going to tank,
You're
going to be facing increased interest rates, which
Yep.
you said even 0.5%. How much?
That impacts your buying power by $20,000 to $30,000. Of what you can afford on a house. It's $130 a month on a payment.
So if the housing market collapses or goes down, where property values are losing 20 or 30,000, we're in a bigger problem
Yes.
than just the housing market pulling back.
Yep.
So I would say that you were absolutely right when you mentioned that if you are thinking about buying now is the time, because of where interest rates are now and where they're headed.
Absolutely. The Fed's already said that they're going to increase them 3 more times in 2019. So there's no end in sight, so do it now.
Yep, absolutely. And the last couple things that I wanted to just point on going forward, what we can expect is the best time to be a buyer is the fall and winter. Again, because sellers are motivated to move their property before the holidays. So right now is one of the best times to be a buyer. And the best time to be a seller is actually in the springtime.
Really?
So that's where we see most of our property value increases is during the springtime. So if again, I just reiterate one last time, I know that this is running longer than our normal market updates, but there's just a lot of information had just came out at the end of this month that I thought really important to cover. That great time to buy. If you're thinking about selling, I'd probably wait until after the holidays, just because that's the best time to be a seller.
Okay.
So if you're in the market to buy, get off the fence, do it now. And if you're thinking of selling, give me a call and we'll do it in the spring.
And if you need to refinance,
Boom.
Check that out as well. It doesn't hurt just to give us a call and we can talk to you about it. And worst case that happens is we just tell you that you're in the best spot possible. So
hopefully you guys found this information valuable. If you have any questions on your specific situation, please reach out to Garrett or myself. We'll be happy to answer them. We'll also be happy to provide any of this market data so that you can kind of come to these conclusions yourself. So thanks for joining us, and we will see you next month.
thank you.